The recent controversy surrounding the calculation of the owner's equivalent rent, OER, and its impact on the Consumer Price Index, CPI, in the United States has sparked a significant debate among economists and policymakers alike. The core of the issue lies in how housing costs are incorporated into inflation measurements. Unlike the direct inclusion of property prices, which are seen as investment goods, the CPI focuses on the concept of shelter as a consumable, factoring in rent and the theoretical rent homeowners would pay, known as OER. This approach aims to reflect the true cost of living, given that housing constitutes a large portion of personal budgets. However, the methodology for estimating OER, especially the emphasis on rental prices for single-family homes, has come under scrutiny. This method has been criticized for potentially overstating inflation, particularly when the sample size of single-family homes for rent is small, leading to higher OER values. The recent adjustments by the Bureau of Labor Statistics, increasing the weight of detached single-family homes in the OER calculation, combined with the current market dynamics of higher rents for these homes, have contributed to a notable rise in OER and, consequently, the CPI. This situation underscores the complexities of accurately measuring inflation and the effects of methodological changes on perceptions of economic health. It also raises questions about the Federal Reserve's response to inflation, as persistent increases in CPI could hinder the possibility of interest rate cuts. For those intrigued by these developments and looking to explore the implications further, the Benjamin Z. Miller Investor Networking Group provides an excellent platform. By emailing ben@benjaminsmiller.com for a free invitation, you can join a community of investors from across Europe and America, participating in weekly discussions that delve into economic trends, inflation, and investment strategies. This group offers a space for sharing knowledge, insights, and networking with fellow investors, enhancing your understanding of current economic issues and their impact on investment decisions. High-yield dividend income funds have always been a tantalizing option for investors looking for a steady stream of income. These funds invest in stocks that pay high dividends, typically from companies in well-established industries. However, the law of high yields comes with its set of considerations and risks that investors should be aware of before diving in. Firstly, it's important to understand what high-yield dividend income funds are. These funds pool money from many investors to buy a portfolio of high dividend-paying stocks. By distributing these dividends to fund shareholders, they provide a regular income stream, which is particularly appealing to those in retirement or seeking consistent income from their investments. The high yield indicates a higher return on investment compared to regular dividend or fixed income investments. However, high yields often come with higher risks. The companies paying these dividends might be doing so at the expense of reinvesting in their own growth, which could lead to stagnant or declining stock values over time. Furthermore, these high dividends might not be sustainable in the long run if the company faces financial difficulties. Thus, investors need to scrutinize the fund's portfolio to ensure it's diversified and invested in companies with strong fundamentals. Another critical aspect to consider is the interest rate environment. High-yield dividend stocks tend to be more sensitive to interest rate changes. When rates rise, the value of these stocks can decline, as investors can find safer returns in other income-producing investments like bonds. Conversely, in a low-rate environment, these stocks become more attractive, potentially inflating their prices beyond sustainable levels. Tax implications are also an essential factor. Dividend income is taxable, and depending on your personal tax situation, it could affect the overall profitability of your investment in high-yield dividend income funds. Investors should consult with a tax advisor to understand the impact on their income and strategize accordingly. Moreover, the global economic landscape can influence the performance of high-yield dividend income funds. Economic downturns, geopolitical tensions, and market volatility can affect companies' ability to pay dividends. A well-managed fund will navigate these waters by adjusting its portfolio in response to changing economic indicators. But this requires skill and experience from the fund managers. The role of fund management cannot be overstated. The success of a high-yield dividend income fund heavily relies on the fund manager's ability to select the right mix of stocks and respond to market changes. Their strategy, experience, and management fees should be carefully evaluated before investing. For those intrigued by the potential of high-yield dividend income funds and seeking to learn more about navigating the complexities of these investment vehicles, the Benjamin Z. Miller Investor Networking Group offers an invaluable platform. By emailing ben@benjaminsmiller.com, you can join a community of investors across Europe and America. The group's weekly meetings provide a forum for discussing investment strategies, sharing insights, and learning from experienced investors. In conclusion, while high-yield dividend income funds can be a lucrative component of an investment portfolio, they require careful consideration of their inherent risks and market dynamics. Being part of a knowledgeable investing community, like the Benjamin Z. Miller Investor Networking Group, can be a significant advantage. It provides access to collective wisdom, diverse perspectives, and the support needed to make informed decisions in the ever-evolving investment landscape. In light of recent concerns raised by UK lawmakers regarding the significant increase in government bond sales and associated risks, investors are advised to navigate these waters with caution and strategy. Diversifying investment portfolios is more crucial than ever, not just across different asset classes but also by geography and type of investment, to hedge against the potential volatility and uncertainties in the UK bond market. Understanding the implications of these developments requires a keen eye on both local and global economic indicators, regulatory changes, and the geopolitical landscape that could affect market dynamics. Moreover, investors should consider the historical context of unlawful activities by banks and the challenges of opaque ownership of UK debt by overseas investors, as these factors could influence the stability and attractiveness of UK bonds. For investors seeking to deepen their understanding of these issues and looking for a community of seasoned investors for exchange and support, the Benjamin Z. Miller Investor Networking Group presents a prime opportunity. By emailing ben@benjaminsmiller.com for a complimentary invitation, you can participate in weekly meetings that cover these topics and more. This network spans across Europe and America, offering a broad perspective on investment strategies and market predictions. It's an invaluable resource for anyone looking to stay ahead in the fast-changing world of investment, providing insights, advice, and the chance to network with like-minded individuals who are navigating the same challenges and opportunities in the investment world. Passive income is essentially money that you earn without being actively involved, typically from investments, rental properties, or businesses that do not require daily operations. It's a key component of wealth building because it offers financial stability and freedom, allowing you to earn while focusing on other interests or ventures. Building passive income requires strategic planning and smart investment choices in areas such as real estate, dividend stocks, or digital products that generate ongoing revenue. The importance of passive income cannot be overstated, as it provides a safety net and can significantly contribute to your financial goals. Whether it's early retirement, funding education, or simply having extra income for travel and leisure, it represents financial wisdom and forward thinking, ensuring you're not solely dependent on a paycheck. For individuals eager to dive deeper into the world of passive income and to learn from a community of seasoned investors, the Benjamin Z. Miller Investor Networking Group is a goldmine. By sending an email to ben@benjaminsmiller.com, you're taking the first step towards joining a vibrant community of hundreds of investors from Europe and the Americas. This network not only shares insights and opportunities but also provides support and guidance, making it an invaluable resource for anyone serious about building and optimizing their passive income streams. Did you know that most successful investors aren't just lucky, but well-trained? Even Warren Buffett, one of the greatest investors of all time, underwent rigorous training. For those eager to follow in the footsteps of such investment giants, there's a unique opportunity awaiting. The Benjamin Z. Miller Investor Networking Group offers an unparalleled platform for both budding and seasoned investors. Here, you'll engage in weekly meetings, diving into a variety of investment topics. It's not just about learning, it's about connecting. You'll have the chance to find project partners, explore passive investment strategies, and network with hundreds of investors worldwide. If you're ready to elevate your investment game and broaden your network, reach out for more information at www.benjaminsmiller.com. This could be the first step towards transforming your investment journey.